Hello, you're welcome to this wonderful time. We want to look at another topic regarding our online webinar we do weekly. And today we want to look at a very interesting topic, understanding key levels and zones. And last week we've gone through a whole lot of different segments of demand and supply and how to identify demand and supply zones, talk about invalidation, okay, zones that are invalid and zones that are valid. So today we want to just cap it up, uh, and give more layers to it by looking at key levels, how to identify key levels. Today's topic is going to take a different approach because sometimes, looking at this concept of key levels, there is just a particular uh, concept I want to establish that will help us, okay? And this concept will also enable us to draw a very good demand, support and resistance, okay? And knowing how to do this key levels thing is very important so as to know at a particular point when the price reversal may likely take place. All right, so this webinar is brought to you by DB Investing, and I am no other person but Mr. Shadrach. I am the financial analyst for DB Investing Nigeria. So let's dive down into what we have for today. So straight up, without wasting much time, we want to look at our charts, and I'm going to take off this, okay, so that we start fresh, all right, and then so that we'll now look at how to identify key levels. First of all, I want to say this very clear that you can identify key levels at any time frame. All right, you can identify key levels at any time frame. It all depends on the time frame you're looking at. But of course, if you identify key levels at a higher time frame, it is stronger. Okay, it is stronger and may hold hold weight or more weight than the ones at a lower time frame. So we'll be playing around different time frames and probably look at different assets and how to identify these key levels. Is that okay? Yeah, so that's what we're going to be doing in this particular case scenario. So let's push on and then let's see what we can achieve for in today's class. And please, this class is very key. By the time you combine this with what we have studied before as demand and supply, and then you now had key levels to hit, it gives thickness, okay, to your trading, day-to-day trading. All right, let's go. Now, let's just take a look at USD JPY, okay? And then let's just see what how to identify this key level. Now, my concept of key levels is this, because of course, different people probably have different concepts of key levels. So this is my own concept of key levels. What I mean by key levels is a case where uh, you identify a zone. Let's say this is the zone, and then this zone has been tested, okay, as a resistance and then as a support. Okay, this is my own concept of a key level, this zone. Okay, that's what I look at as a key level. So a zone that has been tested as a resistance, like this one coming in, okay, on getting to that point, it dropped. It succeeded in breaking it, came back, retest on that point. Okay, so such kind of a scenario is zone like this is what I call a key level. And most times, whenever the market moves, okay, goes and then come back to that point again, it will react. Right? It will react and probably may come back again and then break it. But that first time it comes to hit that zone, it will definitely react. Okay, so that is my own concept of key levels. Okay, so now the thing is, now let's identify it on the chart and then now see how it actually works. So that is what we want to look at in this case. All right. So let's play it up. So now let's push on. This is USD JPY. So let's look at this concept of key levels. For instance, let's see this control. Let's see this this point here. If you watch this point here, okay, the market kind of came to this point, all right? When it came to this point, it reacted. Is that okay? And then it broke that point. After it broke that point, it came to this other point again, it reacted. So now, what we are trying to say here is this, that this point has actually acted, okay, has actually acted at both a support level and a resistance level. You can see that. So now, knowing fully this particular concept now, you can see that this market came to this point. Okay. It reacted. Can you see that? And then it dropped down, retest on that zone again, it dropped. Now, if we go back to our chart, you can see that this at that zone, look at the market reaction at that zone. Okay. If we push on, all right, you see that whenever the market came to that zone, there's a reaction. Okay. So that point seems to be a key point, right? Seems to be a key level in the 4 hours. Mind you, we're dealing with the 4 hours time frame here. Okay. Now, another point we can look at is this point. Like if you watch here, you can see that the market gets to this point. And on getting to this point here, it reacted. Okay. The market dropped down here. It reacted. And then it has to break that point with an impulsive candle. Okay. Even when they did the impulsive candle, they came again to this point and then dropped. So that point where it did come, we can label that zone here. Let's label that zone here. Because this zone has been acted upon or has been reacted upon as both a support level or a support and a resistance zone. Okay, we're trying to map out our zones. So that zones where once the market breaks that zone, we are expecting the market to actually push. Okay, so the market breaks the zone, retest. It can, if we look here again, the same thing happens here. The market breaks this zone level, retest this level, and then drop. You can see that. So those are key zones we are looking at. So we are just trying to see how to identify. So I'm just giving you a scope that in identifying this zone level, we are looking at points that have been tested upon as both a support level and a resistant level. So those are the points we are actually looking at, that our interest is really fetching on. Okay, so those are the points we are looking at. So now let's push on. Let's push on. Here, if we watch this point, we want something a bit more solid. Let's look at this. Let's go to other history. Let's just check out. All right, and we get more points. There are more points, but I just want to give us a very perfect example. Okay, let's just get a very perfect example. All right, let's just get a very perfect example. and then I just need something very perfect. Okay, so yeah, you can see this point here. So let's look at this. Now, as we said earlier, we are talking about points that have been acted upon as both a support level and a resistant level. Okay, so let's say this point. So this point here, let's say we are trying to map it out. You could see this point. Then let's look at this point also. To create our zone point. Okay, let's put it there. Now, this is our zone. And most times, if you get it accurately, what's going to happen is that the market, after breaking out of that zone, we want to come and retest that zone before pushing up. Okay, so if you watch this particular case now, see, the market came to this point, break this zone, okay, came back to retest that zone inside of the zone, and then boom, went. And then if after the market has broken out, it goes, if the market ever comes back to that point again, there will be a reaction, which we have seen again here. Okay, and then let's just look at it and see how the market obeys that point. Okay, so it moves from that point, it goes. Okay, now you see, this is another point, this is another point. Okay, so just mapping out our key levels. Now let's look at the current market scenario here. Okay, now looking at the current market scenario, when I look at it and say, okay, fine, this market here we have, but this is quite a big deal. But if you watch very well, you can see that this zone we plotted here, this zone we plotted here is also the zone this market respected here. Could you see that? Can you see that? Yes, that zone was respected, right? I mean, this zone here, could see this zone we have here is the same zone that the market respected here. Can you see that? See the rejection? All right. So those are levels. Those are levels. Those are levels. Plotting your key levels. Okay. Now let's just watch. Let's just watch. Let's go to a different currency pair and then try to still demonstrate this again. This is a practical class, right? So we just want to do something, be very practical. And then we're just trying to identify key levels or key zones. All right. And mind you, I'm using the 4 hours time frame. All right. I'm using the 4 hours time frame so that whenever the market comes to those zones, you can see that when this market came to this zone level, you can see the reaction. Even if it will break it, but the first time it pulls into that zone, there will be a reaction. And sometimes these are the things that some traders use to actually do some sniper entries. Is that okay? Yeah, they used to do some sniper entries because what they just do, they plot out these zones and wait for the market to come to those zones. And they understand the concept that once the market comes to that zone, there will be a reaction. Okay? Now, if you watch this now from this point, okay, down to this point, probably it might give you maybe 20, 30 pips or 40 pips as the case may be. All right. And so the reaction. Look at this one again. This is a zone. The market came down again. And then when it came back to this zone, look at the reaction. All right. So that is it. Now let's look at other currency pairs and see the reaction. Let's see Euro USD, for instance. Euro USD. Let's look at this. Let's check out Euro USD. All right. So let's see if we can actually find some key levels. What I also said that these key levels, you can get them at any time frame, but the higher the time frame, the stronger the key level. Is that okay? Now let's look at this. Let's see if we can find some nice key levels at this point. Okay, so let's see. All right, so now This is a nice spot. Okay, this is a nice spot. So here the market came, reacted, and if you bring your cursor to this point, you can see that there's a reaction here, right? You can see the reaction here, what the market did here. Is that okay? Okay, so there's a reaction here. Well, let's look at something a bit, I want something a bit very clean, okay? So just do a demonstration. I don't need something a bit very clean. Okay, so something very clean, very clean. And please, if you look at a particular pair and you cannot find very clean key levels, okay? Very clean key levels, okay? There are key levels everywhere, but I'm talking about clean key levels that when you look at this, you're very confident that this is a key level. You can just leave that pair, go to another pair. Is that okay? Okay, so let's see. I just needed something very clean, right? So let's look at GBP, USD. All right. Let's look at GBP, USD, and then let's look at it. Okay. Now, let's see this. Okay, so let's look at this. This 4 hours. If you watch this market critically, this seems to be a very nice level. Why did I say so? Because the market came here, react, you can see, react, okay, react. So here, okay, we're trying to get a zone that has acted as both a support level and a resistant level. Okay, so that's it. So let's see that zone. So let's look at it. Let's see the zone. Right? Nice. So if we keep this stuff here, okay, let's keep it here. Although it's quite big, right? It's quite big. You will see that though we have a very big zone here, because now that's another very important thing you should learn is that if the zone is too big, you know, that means that if you want to come into that trade, you have to be risking much. Okay, so uh, there's a lot of things you have to look for zones that are a bit not too big, right? All right. So, but we're just taking for an example. Look at this zone. Okay, it is this same zone this market came to. If you watch very well, when it broke out of this zone, all right, it came back to retest on this zone again before it actually pushes up. It has been a regular phenomenon of the market, behavior of the market to do so. All right. It has been a normal behavior of the market. So it came back to this zone right again, and then before it pushed on. Now, here you could see that this market has come back to this zone, right? And definitely there's going to be a reaction. Okay. Yes, it may break this zone, but there will be some reaction. Okay. And then before having an impulsive, and most times for a market to break a zone, it requires an impulsive movement. Okay. Yes, it requires an impulsive movement most times. Is that okay? So that is it. So now let's see from here. You can see we have this, see the push, and then you can see what's going on here right away. That's nice. Okay, you can see the reaction here because it has come to a zone level. Now let's go ahead and look for another zone. You can see how the market is reacting to that zone. You can see all of these points. That zone is affecting the market. Look at it. You could see how the market has been reacting around that point. Is that okay? All right. So now let's push on again and then look for other zones. Okay. On key levels, on key zones. Like I earlier said, you can also use other time frames. Let's say, let's look at the 1 hour. Let's check it on the 1 hour time frame. Okay, so let's look at on the 1 hour. Let's see on the 1 hour time frame. Now, like Ahelia said, that we are looking at that point in the market that has reacted as a support level. Like if you see this market here now, at this particular point, you will notice that this market went up, got to this point, retraced, meaning that there is a resistance at that point. Okay, and then you get to this point again, you will notice that this market went up, get to this point, from this point, it pushes up. Is that okay? That's a support at this level. So this point becomes a zone. I don't know if you capture this. This seems to be very clear. Do you understand? This point becomes a zone. The market pushes up, reached the starting point, dropped. Now it broke past that point, okay? Came back again, did a support, came to a particular point, support level, and then pushes on. Now, in between is what I call my key level or key zone. If you understand this concept now. Okay, now watch that zone. Now let's look at it in the 1 hour and then let's trace it. Sorry, let's trace it. Let's trace that zone. You could see that how the market respected that zone. You could see that when the market came here, just look at, you can see the reaction in 1 hour. And see, you could see. So this is it. You could see that reaction here. All right. So that is it. So that point, the market will react at that point. And now it has broken that zone there. So we are expecting like to fall. All right. So by the time you mix up this with other conflict, like now, in this case, now let's say this is your trend line. Okay, you push on, and you could see that this market has broken this particular point. You came back again, retest, you just react around that point, and so on. So this is the point we call our key levels or key zones. Like this one now, I'm dealing with it in the 1 hour time frame. Is that okay? Because I said you can do it at any time frame of your choice. Okay, you can do it at any time frame of your choice, but just know that the higher the time frame, the stronger the key level or key zone. All right, so that is it. Let's push on. Let's push on. Let's look at another pair, and then we can go to even daily time frame. Let's look at say GBP JPY. Let's look at GBP JPY. Okay, so this is GBP JPY. Now let's watch this. This is 1 hour. This 1 hour. Okay, so this is GBP JPY. So let's see how we can identify these key zones. Watch this market. If you watch this market stopped here, correct? Okay, let's keep it. This at the week. Let's the body, right? So let's say the market was coming down, and then at a certain point here, there was a reaction here. The market seems to have a support level here. Okay. Then when this market broke down, the market started going up again. And then on getting to this point, there seems to be a resistance here. And then market started dropping. So that point, that zone has acted as both a support level and a resistance level. Okay, that's it. Is that okay? So this point becomes a very key level that we have to consider in the market. Now, if you want to prove it, just go back to history. So let's go to history and see the reaction at that point. We'll see. Okay. Let's see the reaction at that point. Okay. You have not gotten any market. So that point seems to be very far from the market. Is that okay? Okay. No problem. So, well, that's it. So you could see that that point has acted both as a support and a resistance level. Is that okay? So that is it. So that's how we map out this particular stuff. And then and in this key level stuff, we are trying to identify those points that, yes, there are key levels, but the gap is not too big. All right? Yes, the gap is not too big. Like this is quite top notch. This is quite okay. Right? So when this market breaks that level, okay, it has acted as a resistance, it broke it, and then now acted as a support level here. Okay, this point becomes a very important region. So now, in order to use this method to trade, we can now look at if we can have a trend line confluence with it, okay? Like something like a trend line confluence. We have, okay, this is the trend line. Okay, the market broke the trend line, and then bam, we come into the market here, and then down we bullish. Okay, so here we have the zone accompanied by a trend line, a break of trend line structure, a trend line rather, and then pulling. Okay, very simple technique. All right, so now let's look at another zone level. Okay, we want to find key levels that are not too big, the zone that are not too big, and then there we look into the whole stuff. Okay, so let's push it. Okay, so here the zones I'm having here is quite a little too big. I need something a bit more clear, right? Yeah, key levels that are a bit more clear, and then yeah, there are key levels everywhere, but we want something that is very clear that we can actually attest and be very confident that okay, this key level is clear enough and it's not too big enough for me to take a trade like this one. All right, so let's see another one. If you can't find a very nice key level, just go for another pair. Okay. Now let's see this. Let's see this. Nice. Let's see this one. Here you could see what the market is doing here. Boom. Okay. Since that all of this is just reacting at this particular level, this particular level, this particular level. Okay. You can see that. Now, next we have this point here. This point. Okay. Because though the reaction is not much, because when this market came here, retest on this point, it dropped a little before actually breaking, and then came back to retest in this zone, okay? And then boom, it went. Okay, so that's a very nice, important zone level. Okay, you can see that. Because most times, like I am saying this, is you can see that this particular pattern is repeating every now and then, it's just repeating the same pattern in the sense that it will break the zone and come back into the zone, and then and once it leaves that zone again, it doesn't come back into that zone again. That's it. So you see here, look at this zone level. It breaks it, retest into it, and then off it goes. And it never came back to that zone again. You can see. You see the movement. Very clean. Very clean. Okay, so that's it. That's it. And then if you check this particular zone level, okay, that is where you can see that it also reacted in this zone. That's this particular point again. The market came to that zone, it reacted, you can see, and then bam, it drops. It broke that zone, came into that zone again, and then it drops. That's it. So you see, so that is how we identify these key zones or key levels. Very clean, very simple way of identifying this stuff. Okay, it's a very practical section because, well, when you want to trade, these are the things you do. You first of all identify your zone. Like look at this one now. We have this zone level, okay, and then we have a trend line confluence here. You can see, right? We have a trend line confluence there. So if we draw our trend line, say here, okay, for instance, okay, so the market breaks the trend line. This is a very powerful zone, okay, key zone or key level, and then now accompanied by a trend line breakout, okay, from a trend line, and then here we go. The market does scale retest and then pushes on. That's all. Very simple system, okay. The same thing here, okay. This is our level, and then we see the market giving us a trend line pattern here, just a trend line structure, which we capture with our trend line, and then it breaks it, and then we go. That's it. That's it. Okay, that's it. So that's just the pattern. That's just the pattern. Okay, so this is what understanding key levels or key zones helps us to do. All right, yeah, it helps us to do that. So that's just a simple, quick, just a simple pattern. Okay, and you will also observe that each time it does so, like here, each time it does so, there's always a trend line structure the market will always give, okay, of which if it breaks that trend line structure, like here now, sorry, let me draw it clean. Okay, we have this one. Okay, so you can see this trend line. So the market came, and then as it breaks its trend line, retest on it, that's all. Put your stop loss here. It never came to this low again. Never. Simple. Simple. So, okay, so that's what we're talking about, the key levels and zones, okay, how to identify them. Now, when you add this layer to what we have studied previously, last week and upper week on demand and supply zone and the invalidation point, you'll see that you can capture a zone that you know that when the market breaks out of that zone, okay, and then like what I've just shown us here now, it is going to be a point where it will be difficult for the market to come back, okay, and then from that point you can see that the market can begin to push up to your take profit position or whatever. One of the most reasons why a lot of traders, when they go into trade, they say the market went against them and hit their stop loss is because they are not actually identifying key levels and zones that the market seems to respect. So once you identify that those key levels and zone the market seems to respect, you will do better trading decisions in the market. Okay, so that is how to run this. Just one more example. Let's just take another pair and just one more example. You can take CAD JPY. Let's look at CAD JPY. Okay, and then let's see CAD JPY. Just this last example, and then we're done. Right, you could see this. The market always gives these zones. You can see them every now and then. Right? You can see them every now and then. And I said earlier, I can do that any time frame, maybe it's 1 hour, 1 minute, 5 minutes, but just that the higher the time frame, the better. Okay, so let's look at this now. For instance, look at this. You could see the market reaction here. So that seems to be like a support level here. Okay, is that okay? Now, after this support level, what happened again? The market did a break and then came as though you want to retest this point again. Okay, so we have another level here. All right, so that is it. Now, so this becomes a zone. Okay, a key level. Now, after we've identified that point now, what else? We now look for a trend line pattern that the market has created as a result of him trying to retest this zone. Okay, so now the one we see here as our trend line, little trend line this for it, if it breaks it out, is this particular one we are seeing here that it does. Okay, yeah. So after that, the market did this and then it breaks out here. So from here, we come in to our trading. Simple. Simple technique. Okay. Yeah. So we have our zone, trend line confluence, break of the trend line, we come in. Simple. Right. So that is just the case scenario. And I said, if the zone is too big, okay, well, that means because we would love to keep our stop losses just above the zone. So if the zone is too big, that means you'll be risking more. Is that okay? So because of that, we'll look for zones that are a bit very sizable. Okay. Yeah, if it's too big, we might let it go and look for another particular asset to trade. Is that okay? Yeah, that's it. Look at this one again. What do we have here? So we have this. Okay, so that seems to be like a good, nice support level. And then what else? We have this other one. Okay, so that seems to be a good key level. All right. Now, again, if we watch very well, it gives us a trend line confluence, right? So that's it. So we just capture our trend line confluence. That's it. Okay. And then it breaks to our stop loss above, and then we push. That's all. You see that? So that's just a simple technique we we use in this particular case scenario. So, ladies and gentlemen, I guess this particular trading demand and supply, key understanding key levels and zones, we add to your trading technique. Okay, this alone, you can use the system alone to do your good trading, good trading. Okay, so but don't use just key levels alone. Like you can see what I did. I also involve trend lines because every time it breaks and retests a certain key level or zone, there is going to be a trend line structure that the market will create. So when it breaks that trend line structure, we can come in, put in our this, and then put our stop loss just above our zone. All right, so that's just a simple technique. I guess this particular lecture makes sense and will help you do better and good trading decision, okay, in the market. So this is all about understanding key levels and zones. You can, like I earlier said, you can try it on daily, you can try it on 4 hours, you can try it on 1 hour, you can try it on 15, 5, or 1 minute, depending on your time frame you're using. But if you are doing it from a higher time frame, say 4 hours or daily or 1 hour, they seem to hold more weight than that of 15 and 5 minutes. Okay. So if we're going to trade in, say, in 5 minutes or in 15 minutes, you can draw your key levels in 1 hour or 4 hours, come to 15 minutes or 5 minutes. And then when the market comes to that zone and then has broken a trend line structure, then you can come in for your market. So that's just a simple way to identify. But now you understand the concept of key levels and zones. Okay, my concept of key levels and zone that I just introduced to you. Thank you so very much, guys. Nice having you in this particular wonderful section of understanding key levels and zone. I'm no other person but Mr. Shedrack, a financial analyst, DB Investing Nigeria. Thank you and bye-bye. See you next week.